Welcome back to another video, guys. Today we are going to be talking about all the different ways that you can trade ORB. Traditionally, as I have made this indicator here, you can see we had one loss and one win today. This ORB indicator was specifically made to trade the breakout of the opening range. However, I not only want to touch on the positions that the indicator was able to do today, but also all the other ways that you can trade the opening range breakout. As you know, the market goes through different regimes, right? A lot of the times we can have volatility regimes where breakouts are more likely to be favored, whereas other volatility regimes where mean reverting strategies like ICT are more favored. Generally, during that December into the beginning of January, we have a more mean reverting environment. The reason for this being is primarily because the volume is relatively lower compared to all of the other latter months of the year, right? Without any further ado, let's jump into the positions today with the ORB indicator that we have made, as well as the mean reverting positions you could have taken. Yes, with the indicator, but not the direct signal, and I'll show you what I mean here shortly. First of all, unfortunately, I did not take these longs today. Although they did hit TP, I did primarily favor these shorts. And here's why I really like the shorts. First of all, I was putting in to the community this morning, right? I said we had this wick liquidation right here, right? We had this break of structure from Friday as well that was really clean. I then drew my Fibonacci high to low. I saw this rising channel into this Fibonacci level. Then I also saw this 15-minute fair value gap. Analysis is pretty clear. Now, if I come back to the charts and show you guys that very quickly here, right? Let me just come out into a larger time frame. Here's Friday's price action. I saw Tuesday's high getting wick rejected right here, right? We also saw that price was making lower lows, lower highs, lower lows, lower highs, and lower lows. In fact, we had a lower high to lower low. We induced this level here. So essentially what I saw was we ran in to this imbalance, right? Wicks are just imbalances on lower time frames. I saw this liquidation. We wick rejected Tuesday's high, which told me we trapped traders here, telling me that we have a strong high right here, right? We then continued to break Wednesday's low with a lot of momentum as we saw here. And just as you guys saw in the analysis, I did high to low right here. That brought in that zone that you guys saw here. We can see that order flow coming into the market. I made that a light purple, right? I basically indicated that this was a 50% fib level. And then I also saw, let me get rid of this Fibonacci. I also saw that we had this fair value gap coming in right here, right? With that being said, at the beginning of the session right here, I saw the low resistance liquidity run, this build up, this channel, like you see. Let me go ahead and dot that out. What I do is I copy and paste that to the nearest high before the open. That was right around here. So nonetheless, we have this rising channel. With that being said, I was expecting the manipulation of the channel here. And of course, I am now waiting for this to come back down to these lows, as I just showed you with my analysis here, right? Now, unfortunately, it didn't dump as soon as I'd like it to. If we come back to what I was saying, I said expect the false quick bullish move. And then essentially what I was saying is we're going to dump right after, as this arrow was indicating here. Well, on the bright side of things, if I come in to this analysis at the open, right, you can see we're manipulating the upper half of the trend here. And we did, let me come back out to the 5-minute, actually it'll be a little bit more clear. As you can see at the opening range, we did have that initial false move to the upside, which is exactly what I was looking for. And then I figured, okay, if we manipulate wick reject the high of the day here within our 15-minute fair value gap, within the 50% Fibonacci, while also manipulating the rising channel trend here, this should be a pitch perfect short. And it was, it was a great position. It was considered high probability in my eyes. And, I took the short here. I moved my stop losses down 25% as soon as we started moving into profit over here, and unfortunately got kicked out of the position. I did not take the longs because I didn't see any reason why the market would continue long. My bias was overall short, and we just weren't able to get into this. If you were to follow the data, the strict raw data of this indicator, you would have come out 0.5% in profit today, right? Because the risk to reward is a 1 to 1.5. Now, if you were to follow the breakout of ORB today, you would have done fine. But more importantly, I want to show you guys how you can trade the mean reverting like environment for this. Another way to trade it. This is more so the ICT style of trading ORB. As you guys saw, my daily bias was overall short. So if we were to make the fake out to the high here, we would want to try and catch this fake out, right? So how would you catch this fake out if the opening range, as we see as indicated by the indicator, is right here? So here is the range that the indicator printed. I'll go ahead and mark that out and I'll get rid of the indicator. Essentially, what we can understand is when price makes this false move up, we need some sort of way in order to take the trade back down. All right, well, a lot of you guys are familiar with inverse fair value gaps. One of the first things that you can do or identify is when price starts deviating away from the range. What you can do to understand what deviations is you can take this box of the range, right? Let's make that a darker color. And now what you can do is copy and paste that. This would now become one standard deviation, and down here below would be -1 standard deviation. So this would be -1 standard dev, and this would be +1. Hold on. Right. So as you can see, when the market has moved already one standard deviation away from the original range that it created, it told me that we moved enough to be able to look for some sort of inverse fair value gap to trade the mean reverting environment, right? With that being said, if we look here, we can see that our first inverse fair value gap or fair value gap was created right here. The market came in, respected it, went higher, and then we made another fair value gap right here that was eventually inversed right here. Now I am on the 30-second chart, and you're probably wondering why I'm on such a small time frame. Well, the market, as you know, is going to move the most within the first minute to 5 minutes of the New York Stock Exchange Open, which is at 9:30 a.m. New York Eastern, right? So we're going to get a lot of volatile market movements, meaning if you're on higher time frames such as the 5-minute or higher, you're not going to get a lot of clear gaps, but you will get a lot of clear gaps within the 30-second or 1-minute time frame. I generally like to look at, the 30-second time frame. The 15-second or anything lower than the 30-second will tend to have too much noise. Anyways, here's this inverse fair value gap. The way that we trade them is extremely simple, right? So here is, I'll draw this out so you guys can understand. Here is that New York opening range, pre-market range, whatever, it's the New York range, right? We're essentially waiting for the open to occur. And if we're trading ICT, mean reverting like strategies within a mean reverting market regime, we're either looking for price to manipulate, go the other way, and or manipulate, move the other way, right? Now, the way that we confirm that is we wait for price to manipulate, we wait for it to present some sort of gap, right? And then inverse that gap and close beneath it. And then we'll take our position, stops above the high or stops above the inverse fair value gap, and we'll target either a 1-to-1, 1-to-2, or opposing liquidity, right? Now, taking a little bit further look into this, given that I just showed you everything there, here's where we're going to enter our position. We're going to enter shorts as soon as this candle closes, right? If you're more of an aggressive trader, you're going to have your stops just above where the inverse fair value gap was. If you want to be a little bit safer, right, or a lot safer, you can have it above the high that the inverse fair value gap has created. Or if you want to kind of meet yourself right in the middle, we can turn on 1-to-1 fractals, and you can have it at the nearest 1-to-1 fractal like so, right? So those are the three different ways that you can place your stop loss within this mean reverting like environment. Anyways, let's get rid of the fractals because it tends just to create too much paint on the chart. Now, as you saw down here, where I would go break even, right? Generally, when I go 1-to-1 or whenever price goes 1-to-1 is when I would go break even. And if that were the case, you would have hit your break even right here. And or I would go break even at 1 standard deviation, which is down here, right? This is -1 standard deviation of the range. In terms of targets, it's really up to you. I don't really trade the strategy all too much, primarily because the market tends to have more volume than not. And today, I thought we were going to have a lot of volume, considering that it was like the first real trading day of the month after the holidays, and relative volume was actually pretty high. So I wanted to trade the breakout, and the breakout looked extremely healthy. But unfortunately, we wanted to trade ICT today. Nonetheless, right? All the different ways that you can target, posing side of the range, -1 standard deviation, fixed risk to reward, such as going for like a 1-to-1 or 1-to-2, or you can even try to target opposing liquidity, such as we just took out the current day highs. We can try and target the current day lows down here, which would have scored around a 1 to 0.58 or 1 to 0.6. My fault, 1 to 6. Fortunately, we didn't come all the way down to the lows, as we can see right there, but we were able to tag at the very most today a 1-to-2 with the strategy. Now, I would not recommend, once we take out one side, I would not try and trade the other side. In other words, don't try and trade the windmill. Generally, once markets have made its manipulation at the first minute of the open, the manipulation won't be as strong, right? Because what will happen is the market, just like news events, will move one way, which is the false move, and then move the other, which is essentially what's happening here, right? Now, a little bit more added confluence to this manipulation to the high was this low resistance liquidity run. Whenever we make this upwards trend into the New York session, right, and that goes for downtrends as well. So let's pretend that we're in a downtrend. A lot of the time, what you're going to see is that break lower and then move the opposite way. That's essentially what's happening here, where we have momentum or consolidation, price building up here. And now we're manipulating to the upside. Now I'm expecting price to move back down, right? That's that manipulation of the rising channel. So that's really it. I wanted to show you guys what I see, not only from a breakout perspective, but also a mean reverting perspective as well. I have coded this specific ICT strategy, and it's not profitable without other confluences alongside it, such as what I was just showing you there with the daily buys, or how I look for daily buys. As an example, this was running into a 50% Fibonacci level. It was also running into a 15-minute fair value gap. So it had the high time frame bias to tell us that, okay, we hit a wall here, and then it further confirmed that with the 30-second iFVG, while also manipulating the opening range, which was this right here. So overall, it was a really good setup today for ICT. Let me just show you guys, I do have an ICT indicator for this. I'll pull this up very quickly. I'll get this high time frame narrative on the 15-minute, right? And then what you're going to see here shortly is that 15-minute fair value gap. Because it's already mitigated it, I need to show the visual mitigation. It's going to take, it's still loading up here. It's such a powerful indicator, this iFVG indicator, that it takes a little while for it to load, but it's going to identify this 15-minute fair value gap here. All right, so as you can see, here is that 15-minute fair value gap. It's red because that basically means it got invalidated, which it did over here. Now, if we come into the 30-second, that's where I have the entry. Give it a second to load. Unfortunately, it's not identifying that little 30-second right here. This is something I need to patch up. That's what I'm trying to get in there at the moment. 1 second. Let me see why that is. Pre-market session. Let me try bringing this down here. Doesn't want to identify the lower time frame entry. All right, well, unfortunately, I'm still working on this iFVG indicator. It's going to take a little bit to get this one perfect. We'll get this back to 9:30 here, trading session. Maybe let's try bringing that to 9:15 and see if the indicator will get what we want here. Because the logic that I'm trying to include in it is once we sweep, as you can see, this opening range box right here, right? It's trying to look for this iFVG. As you can see, it swept this low here and it found this iFVG. So it's saying you could have entered long here, right? But yeah, we were essentially waiting. Let me see if this prints maybe in real time. You can see here it is invalidating the 15-minute. There it is. All right, so you have to just replay it in real time, right? So here it is in the 15-minute fair value gap. Here's the range. It's manipulating that range, right? There's the inverse fair value gap. As you can see, it just printed right here. And with that being said, you would enter short, right? After the inverse stops above the high here. You can either target the opposing range and or wait to aim for this 15-minute fair value gap right here. And then there you go. That is essentially the play for this. And it's lagging like hell because this indicator is just so long. There you go. Right. But nonetheless, I hope this video was helpful. That really is the ICT orb setup, right? Just to show you again the way that you can view it very simply. There's the range, right? Let's say we're in a low resistance liquidity run to the upside. Eventually price will chop. This is considered that chop, right? We want to see the manipulation into some higher time frame fair value gap, such as this right here, right? Manipulation is here. Have some sort of entry model like so, right? Inverse fair value gap. When price comes in inverses that, entry stops above here, targets down here, right? That's it. Anyways, I hope you guys enjoyed this video, and I will see you in the next one.